Hi everyone, this is Miguel in another video in my series 1 Hour Money Power, and in this video we'll be covering the basics of growth investing. Now, growth investing is when you take a look at a company and you realize that because they do such a great job at growing their own profits, that you're going to give them some of your money to grow. That's essentially what buying stock is. That if you buy enough shares to where you own 1/1,000,000th of, say, Google, then that means that you have a legal claim to 1/1,000,000th of the profits that Google generates. So one of the best indicators for measuring stocks and how to determine whether or not something is going to rise in value is by looking at the accounting statements. And there are three major accounting statements that you should look at. The net income statement, the balance sheet, and the free cash flow statement. And in this video, we'll be covering the net income statement. In order to calculate net income, you basically take all of the revenue that they've earned over the last quarter and subtract it by expenses, and the money that's left over is their net income, also referred to as their earnings. Think of it like the company's paycheck, that after they bring in their money and they pay out everything that they owe this quarter, the money that's left over is their check money. And one way that you can measure the growth of businesses is by looking at which companies have the fastest growing rates in terms of their net income or their earnings. And by breaking this down, I have an example of a company. This is a fake company that I saw on an accounting website. The name of the company is Paul's Guitar Shop. And you can take a look and see that they raised a certain amount of revenue, the total amount being $27,800. But then when you subtract all of their listed expenses of $14,850, what's left over is $12,950. And you can actually look at an accounting statement that looks very much like this and break down what a company is bringing in, what they have to pay out, and the money that's left over is essentially the profit that they've generated. You can also look at it on a chart, and I'm going to pull one up right now. This is a chart of Google's net income over the last 10 years. It should be a little clearer now. And you can see that you can chart the revenue that they bring in and the expenses that they bring in, which is going to be measured by the orange and red lines, but the blue line is going to be their net income. You take revenues minus expenses, and what's left over is net income. And when you can find companies that can substantially grow their net income quarter over quarter or year after year, that's one way to measure growth.